I think you have to take a step back and realize that the S&P 500 or other risk assets, broadly speaking, have had a pretty spectacular year. I mean, the market's up, roughly 15%? And this is happening at a time where global economic growth is clearly decelerating and the trade war, if anything, is intensifying. Last week's powerful rally, I think, was really sparked by the Fed and expectations for what the Fed is going to do. It's important that we just take a step back. While this is welcomed, we always like to see markets rally like this. We need to keep it all in perspective.
So you're cautious?
I think we are cautious. We look for opportunities into market strength to incrementally take risk off the table. I mean, ask yourself, to the extent this trade war improves, is the Fed going to continue along this path of potentially cutting interest rates? What happens if inflation actually starts to pick up? That repricing in the market, I think, can be painful, and we just have to be cognizant of that. Expect more volatility in the back half of the year.
Stephen, we talked about being around 2% from the all-time highs on the S&P. What do you need to see to cross that level?
So for me, I don't think Joe and I are on opposite ends of the spectrum, but if you think about it, the rate cuts are what caused the market to rally, or the prospect for rate cuts caused the market to rally. So now you have the market that has a couple of rate cuts in their back pocket, Chinese trade deal in the back pocket, meaning that if it comes out, it's a positive. We've already seen most of the negative. Would you agree with me, Joseph, that most of the negativity on the trade war has been priced into the market at this point?
I'd hope it has been, but you never know, honestly, with this trade negotiation where things are heading. And I guess I would ask, how much more upside is left after everything we've seen?
Tremendous amount of upside, because if we both agree that if the Fed is responsible,
where do you see the downside priced in? We're 2% away from record highs.
So obviously you have to look at those levels where we were just at. So 27, 22 in the S&P cash is where we bounced, but that was pre Powell coming out in a softer, dovish stance. So somewhere midway between where we are now and 27, 22 is your downside, which is better than what it was just a handful of days or a week ago.
Joseph, with your cautious optimism, how are you positioning yourself? What sectors?
I think broadly we want to be positioned towards the U.S. consumer. I think from a regional perspective, we continue to favor the U.S. Not only does it look better from an opportunistic standpoint, but it also provides a little bit more defense in what we think is going to be a choppy environment. And with that being said, focusing on consumer discretionary, focusing on technology, but in particular those stocks that stand to benefit from a healthy consumer backdrop.
I mean, what do you think of those picks? It doesn't sound very, it's not very cautious.
Right.
I mean, it's not very taking risk off the table, but I guess you're looking for spots in the market that make sense.
I think we're looking for spots in the market that make sense, but at the same time, when we think about risk for the vast majority of our clients, it's really about thinking exposure to stocks versus exposure to bonds. And within the equity exposure, where do you want to be leaning? What region of the world? There are also various low volatility equity strategies that you can employ while at the same time keeping some exposure to those sectors that you like.
Let's just think about where Joseph's picks are. Those have led the market for the last 5 years. If the market goes up, those sectors will lead the market. So it's a bet on more positive, more growth, a bullish stance on the market, even though Joe is self-exclaimed cautious in the overall market.